So good morning, everyone, and welcome back to our weekly webinar series. Today's topic is a very interesting one. We're looking at how resolution applicants uh, can plan their taxation and how imperative and important is it for them to plan their taxation with respect to the implementation of the resolution plan. So over to Anil sir for this very interesting deliberation.
Thank you, Ankit. This is the 67th episode of AAA Weekly Webinar Series. So this time, the subject that we chose was, in fact, much in demand. Most of the resolution applicants are, in fact, struggling how to resolve this post-tax liability after the approval of resolution plan. And we are focusing on this part only. We are not focusing on a rainbow paper kind of issues, which also has actually been diluted in another judgment, which came about 4 days back in the case of Raman Ispat. Now, even the rainbow paper has also been diluted, and it is diffused by way of another Supreme Court judgment, which is about 4 days back in the case of Raman Ispat Limited. However, we are only focusing this episode on the tax liability, income tax liability, post-approval of the resolution plan, and we will touch upon the remission and cessation of liability under Section 41, subsection 1 of income tax. We will also touch upon the amended Section 28, subsection 4 of the Income Tax Act. We will touch upon the minimum alternate tax under Section 115JB of the Income Tax Act. We also would see whether Section 656 is also applicable somehow and tax some of the transactions. So, and also Section 79, which empowers. So what we have seen that initially the focus was to give this benefit to resolution applicant. Of late, it looks like as if the income tax department has changed their mind, and they actually got a feedback that this is a kind of double benefit that they're giving to the successful resolution applicants. One benefit, that they will not be subject to any tax liability for the past period, and also they would not be taxed for the acquisition that they have done. And even if the company has earned a huge kind of profit by way of waiver of loan, waiver of term loan, waiver of working capital loans, waiver of unsecured loans, waiver of all kind of operational creditors, waiver of all kinds of advances from the customers, and any other liability in the balance sheet in case it is waived, all that benefit will go to the corporate debtor. So we will go step by step. It is, I would initially would not say that this demand in the market. Everyone talks that we want to take over a company with a lot of brought forward losses because they want to take the benefit of brought forward losses. There are many transactions which are happening even after the sale of various assets of the company. Those companies are being sold as going concern under liquidation, assuming that the liquidation as a going concern is akin to resolution plan, and the benefit would be available, benefit of brought forward losses, benefit of unabsorbed depreciation, that would be available. That is the assumption. However, today we would see whether that assumption is true or that assumption is false. Going ahead, Ankit, is it okay, Ankit, we go ahead with?
Yes, let's go ahead.
So let us understand the demand in the market, that the successful resolution applicant will get the benefit of brought forward losses and the unabsorbed depreciation. Is this benefit a real benefit? Is it true or is it false? Or there may be a hidden tax liability in acquisition under IBC. So there are two things that we are talking about. One, that the benefit which you are assuming may not be available. Second, instead of benefit, it might even turn out to be a liability, tax liability. So therefore, in some cases, desire for taking over a company with brought forward losses, it can be a disaster. Now, let us understand the brought forward losses. One is the brought forward losses as per the books of account, which are the accumulated losses as per the accounting policies, as per the accounting standards. And this particular loss is not even relevant for the entire discussion because that's a book loss. That is even not relevant for the benefit that they have given under Section 115JB of the Income Tax Act. Even this part is not even relevant. Now, the other part is the brought forward losses and unabsorbed depreciation as assessed by the Income Tax Department, or that may be assessed by the Income Tax Department pertaining to period prior to commencement of commencement of CIRP. Now, any loss during CIRP would also be available to the successful resolution applicant, provided the balance sheets are made, balance sheets are audited according to the accounting standards, true and fair view is given by the auditor, income tax return is filed on time, then even that part of the losses will also be available to the successful resolution applicant. However, the unabsorbed depreciation that is available to successful resolution applicant, even if the returns are filed or belatedly filed or not filed. Now, how the market perception is regarding brought forward losses and regarding the benefit that they can take out of the brought forward losses and unabsorbed depreciation. One, that in the company can be revived, and if the company revives and in future the company earns profit, that means those profit will not be taxed because there is an exemption of MAT, and also the brought forward losses will be available. Once the brought forward losses are available, that means that the even 15% plus surcharge, which is the tax under Section 115JB, which is called minimum alternate tax, that also would not be taxable. Now, some people also think that in the company which we have taken over under IBC, we will start some profitable business, we will divert some profitable business so that we save on taxes. And the other way is that they are thinking that they can even merge this company, the company which is having brought forward losses, that company can be merged with their existing profit-making company to save on taxes. These are the three assumptions in the market, and all these assumptions are correct, provided now going forward, we will see how much brought forward losses or how much unabsorbed depreciation is actually available to successful resolution applicant. Now, what are the brought forward losses which can be used to set off current taxable profits? Only those losses which are assessed as losses and permitted to be carried forward under the income tax law. Losses which might be assessed by the income tax department as losses pertaining to a period prior to the approval of resolution plan by NCLT, for which the returns are filed in time. Unabsorbed depreciation as per the Income Tax Act and claimed by the filing income tax return, even if belatedly. However, capital losses can only be set off within the headings capital gains. Long-term capital losses can only be set off against long-term capital gain. Short-term capital losses may be set off against both long-term earnings as well as short-term earnings. Now, but these capital losses can also be brought forward for setting off in future against capital gains. Now, the department has clarified that the losses for a year cannot be carried forward unless the return for that year has been filed before the due date. And also the losses can be carried forward for 8 years, not beyond 8 years. This is not applicable to unabsorbed depreciation. So Ankit, I need your indulgence here. Is this 8-year limit is applicable to unabsorbed depreciation also?
No, there's no limit there. There's no period limitation in
So
unabsorbed depreciation.
that's what I wanted to understand. The period of 8 years is only applicable to brought forward losses, and it is not applicable to unabsorbed depreciation. Ankit, the another question is, for claiming unabsorbed depreciation, is it really required that we calculate the depreciation as per the income tax provisions and file return, maybe belatedly? Or if the returns are not even filed, can we claim depreciation as per income tax law, even if the returns are not filed?
I think that's not available. As far as I remember, unabsorbed depreciation, if it is not being claimed in the ITR, cannot be claimed in future years. But I can check on that and confirm that.
Okay, so now let us understand when this law came, the income tax department, government of India, they were very, very clear that they have to extend this benefit to the successful resolution applicant. So the first amendment was made in section 79 of the Income Tax Act, because the section 79 of the Income Tax Act says that if in a particular year, the more than 51% of the shareholding of a company changes hands, then the brought forward losses would not be carried forward. After the change of 51% of the voting power in the last day of the years or years in which the loss was incurred. So in case the loss is incurred in 2018 and later on all the changes are happening in the voting power, then the losses would not be brought forward. However, with effect from 1st of April 2018, this particular section was made as not applicable to those companies where a change in shareholding takes place in a previous year pursuant to a resolution plan approved under the Insolvency and Bankruptcy Code after affording a reasonable opportunity of being heard to jurisdictional principal commissioner or commissioner. This was inserted by Union Budget 2019. Now, this is also very important that after affording a reasonable opportunity of being heard, so I would advise all the successful resolution applicants and all the RPs to consider the filing of the resolution plan and making the principal commissioner or commissioner of income tax as party, so that that particular clause where their concurrence is required, they should come in the they should come in the hearing and provide their concurrence. In case we try to go to the income tax department and take their concurrence, that's not possible. The only condition is after affording a reasonable opportunity of being heard to the jurisdictional principal commissioner. Now, what I understand here, in case the principal commissioner or principal finds that this transaction under IBC is only a sham transaction, the only objective of this transaction is to transfer the carried forward losses to another entity or to another business house or to another person, then the principal commissioner will object and will explain that by selling this company as a going concern, nothing is actually getting revived, nothing is actually being resolved, but this is the only objective of carrying forward the losses. That's the only understanding that I have why this particular reasonable opportunity is given to principal commissioner or commissioner. Now, then another thing which came as a hurdle was the minimum alternate tax. The Union Budget 2019 came forward, and with effect from 1st of April 2020, the Ankit, I'm audible, na?
Very much.
Because I'm getting some frantic calls on my mobile, and I don't think there is any message on the Q&A also. So when some people are calling from undisclosed numbers, I thought it is something they want to give a feedback. while I'm
No,
live.
you can definitely speak a little louder, but then it's perfectly okay. I can also increase my volume. In fact, rather I think your volume should be good. I'm just increased my volume on my system, so it will get better. And I have no feedback from anyone with respect to you being not audible.
Okay, so this particular hurdle was also kind of uh, uh, clarified, and it was taken away when the amendment was brought into section 115JB, and that amendment was that uh, the while we calculate the book profit, the entire unabsorbed losses would be, and also the unabsorbed depreciation would be reduced from the book profit for the purpose of minimum alternate tax, all in any year wherever you need to do this. However, when we look into this 115JB, we also have to see various other. Normally, when a company is not under IBC, then there is a clause that from the book profit, we are also allowed to reduce unabsorbed depreciation or unabsorbed brought forward losses, whichever is less. So in case the out of these two, losses or depreciation, if any figure is zero, then the zero allowance is given. And this particular amendment has brought that if a company has been undergone insolvency, then the entire brought forward losses and entire unabsorbed depreciation as per income tax, that would be allowed to be reduced from book profits. So this is actually very important. Also, the section 115JB defines that the financial statements, a statement of profit and loss account, that should be prepared according to the provisions of Schedule 3 to the Companies Act 2013. And the annual accounts, including the statement of profit and loss account, that should be prepared according to the accounting policies, the accounting standards adopted for preparing such accounts, including statement of profit and loss account, the method and rates adopted for calculating the depreciation shall be the same as have been adopted for the purpose of preparing such accounts, including statement of profit and loss account, as laid before the company at its annual general meeting in accordance with the provisions of section 129 of the Companies Act. So this balance sheet that we would make for the purpose of calculating minimum alternate tax under section 115JB, that particular balance sheet has to be according to section 129 of the Companies Act. Now, when we see the section 129 of the Companies Act, we read as under what section 129 of the Companies Act provides, that the financial statement shall give a true and fair view of the state of affairs of the company. So any balance sheet where the auditors have not certified the balance sheet as true and fair would not be a balance sheet for the purpose of filing income tax returns or for the purpose of calculating the tax liability under minimum alternate tax. This particular financial statements, including profit and loss account, must comply with the accounting standards notified under section 133. And it should be in the form as provided for the different class or classes of the companies. Now, then we saw the balance sheet that on which the section 115JB liability would be calculated. That should be the same balance sheet which is placed before the board of directors under section 129 subsection 2 of the Companies Act. Now, the balance sheets, the financial statements, the profit and loss account should be as per section 133 of the Companies Act. Then the companies in bracket accounts rules 2014 was also notified. Then companies Indian accounting standard rules to 2015 was also notified. Now, when we saw all this, that actually means that it is not really possible. It is not really possible that the all the liabilities waived can actually be transferred to capital reserve. Why I'm saying so? Because then I actually saw the Indian Accounting Standards 109, and when I saw this paragraph 3.3, which is derecognition of financial liabilities, then the 3.3.1 paragraph reads as us. The entity shall remove a financial liability or a part of the financial liability from its balance sheet when and only when it is extinguished. That is when the obligation specified in the contract is discharged or cancelled or expires. That is the first requirement of the Accounting Standard 109. Now, the second requirement is that the difference between the carrying amount of the financial liability or part of the financial liability extinguished or transferred to any other party and the consideration paid, including any non-cash assets transferred or liabilities assumed, shall be recognized in profit or loss. Now, it means that we have to take all waivers, all cessation of liability, all remission of liability to the profit and loss account. So we cannot take it to the capital reserve and direct to the balance sheet. And once we take it to the profit and loss account, that means the provisions of section 115JB are applicable. Although entire brought forward losses, entire unabsorbed depreciation are allowed to be set off after the approval of the resolution plan. So what I'm trying to say here, that the financial statements made, which are not as per section 129 and 133 of the Companies Act, may not be acceptable by the income tax department. So Ankit, any part of your comment here? Because this is very important that you do a lot of income tax and auditing. So maybe that you can add a few points here. How the balance sheets can be rejected by the income tax department if it is not made under 129 of and 133 of the Companies Act for the purpose of calculating tax liability under 115JB.
So 2-3 things that income tax talks about, the way it protects the taxation liability. So of course, the profit that one is declaring in the P&L is important, but then there are also provisions across the Income Tax Act which talk about how if you take any income directly to the reserves, even that is taxable by the income tax. Then there are computation standards. So one objective is, of course, that you're following accounting standards. Then there is something called Income Tax Computation Standard, IBC. So those standards are also enforced today, so that income tax computation standards are also required to be followed by all companies which are filing their income tax returns. So end of the day, the idea is that there should be a standard way of computing the tax liability, and you shouldn't be, using journals or using some creative techniques to avoid tax liability from your financial statements. Otherwise, it will be caught either through non-compliance of accounting standards or income tax computation standards, or non-compliance of various provisions which say that if you don't route something through the P&L, that it becomes taxable. So I think that's the idea. And we can always go through. I think there are many questions. Can we take some questions?
So I just want to finish this.
And then we can take some questions, perhaps.
Then we can take some questions. Now, also would like to discuss some apprehensions are there amongst professionals that this income of waiver may even be taxable under section 56, subsection 2, which is income from other sources. Because in this section 56, subsection 2, what it provides, in particular and without prejudice to generality of the provisions of subsection, the following income shall be chargeable to income tax under the head income from other sources. Now, when we go to the subsection 10, Roman small 10, where any person receives in any previous year from any person or persons on or after first day of April 27, because before 2017, there were different kind of law, any sum of money without consideration, the aggregate value of which exceeds 50,000 rupees, the whole of the aggregate value of such sum would be taxable. So there's an apprehension that this particular waiver or this particular concession, like the cessation of liability, may even be taxable under section 56 subsection 2. Now, I am not of the opinion that this particular can be taxable, because this is only pertaining to the amount received during the year. And in this case, remission of liability, cessation of liability, waiver of liabilities, these are all not received in the year. We are, in fact, kind of waiving it. So this particular section is not applicable because this is basically, it is not receipt of anything, any property without consideration, but it is a waiver of loan. However, there is another clause, which is this clause C, which says where any person receives in any previous year from any person or persons any property other than immovable property. Now, any property other than immovable property can be shares. Without consideration, the aggregate value, fair value of which shall exceed 50,000 rupees, the whole of the aggregate value. And the B says, capital B says that for a consideration which is less than the aggregate fair value, fair market value of the property, by an amount exceeding 50,000 rupees, the aggregate fair value of such property as exceeds such consideration. Now, in case in a resolution plan, Ankit, in a case I propose in a resolution plan that instead of extinguishing the capital, I will take the shares of the promoters or the shares of the associate companies. If I take those shares without consideration as zero value, then the income tax department can come up that section 56 subsection 2 and the subsection X and clause C is applicable, because you have received a property and the definition of property includes shares, and you have not paid any consideration, or you have paid only 1 paisa or 10 paisa per share. However, the fair market value of the shares will have to be calculated as per rules 11U and 11UA. So this part is also to be seen. So whenever we take over a company, whenever we get the shares transferred, this is one option in resolution plan, is that we extinguish the existing shares. Second option is that we get the existing shares transferred to the new management and new owners. In case of the second option, one has to be very, very careful that the fair market value of the shares, that also should be assessed as per rule 11U and as per rule 11UA under the income tax rules. So this is another option where some possibility of taxation is there. However, in the other clause, which is the clause which is clause A, there is no possibility of taxation. Now, Ankit, what happened is that when the income tax department started thinking that how can we tax this waiver part of it? So first they in fact made a way that these waivers should actually not become a very heavily taxable. Then they came up with section 194R of the Income Tax Act, and this was introduced in the year 2022. And they provided that tax at source would be deducted at the rate of 10%. Now, this particular action was a clear intention that any waiver of loan, any waiver of liability, or any kind of benefit or perquisite given under section 28 subsection 4 would be subject to a tax at source at the rate of 10%. So in fact, there was a guidelines also, circular number 12 of 2022, which was given by CBDT. And in the said circular, what is mentioned? It was mentioned because see, the Income Tax Department was struggling with the Supreme Court judgment of Commissioner versus Mahindra and Mahindra. In that judgment, this Honorable Supreme Court has said that in case the benefit is in cash, then section 28 subsection 4 is not applicable for taxation. that particular section is only applicable for non-monetary benefits. So then the income tax department was struggling to diffuse the impact of that judgment, commissioner versus the Mahindra and Mahindra. So in this circular, even the income tax department said that this particular circular section 194R would be applicable even to a perquisite benefit in cash as well. So like just forgetting the judgment of Mahindra and Mahindra, they said even if this benefit is in cash, it would be subject to tax at source. It was further mentioned that the principal amount of loan waived being the borrower would also be covered under section 194R. Even before the amendment in section 28 subsection 4, they brought section 194R a year before. So they tried to cover this issue of Mahindra and Mahindra, and they wanted to tax all kind of waivers under section 28 subsection 4. So they brought this circular. And also the language, like it is completely the language which is used in 194R, it is mirrored the language used in section 28.4. So this particular 194R was brought only to tax all the waivers under section 28 subsection 4. Then they came up with another circular, and that circular was in the other circular, which is the circular number 18 of 2022. So it was mentioned in the other circular that it is very clear, Ankit, the TDS under section 194R is deductible irrespective of the nature of benefit or perquisite, that is capital or revenue. So that means they were eyeing at taxing the term loans waiver under section 28 subsection 4. And that is the reason they are repeatedly saying in the circular, whether in cash or in kind, whether capital or whether revenue. However, one exemption was given clearly, so that that particular amount is taxable, but the tax is not deductible. And they in fact said that the TDS under section 194R is not deductible in case of one-time settlement with the borrower, waiver of loan granted, or reaching settlement with the borrower by principal financial institutions, scheduled banks or cooperative banks, etc. So that means it was very clear on their part that they want to tax the loan waivers. They want to also deduct the TDS. Therefore, the intention started in 2022, and then finally the amendment came in section 28 subsection 4. Ankit, some people are saying that even the operational creditors, when their liability is waived, are they also supposed to deduct tax at section 1 under section 194R? Now in insolvency, like this exemption is available only to the banks and scheduled banks, principal financial institutions, cooperative banks, but there is no such exemption available to other parties whose liabilities are being extinguished. Are they also supposed to deduct tax? No, I said absolutely no, because for them it's a bad debt. They are not giving any kind of voluntary benefit to any other person. They are not signing a one-time settlement with the other person. They are only, for them, it is only a bad debt. For them, it's only a bad debt.
I think it will help you, it will help the process or everyone to understand that whenever we write off and whenever we write off a bad debt, the income tax form today asks us to put in the PAN numbers of those parties where the total, where the amount written off is more than 1 lakhs. So the information with respect to what people or which people have not paid to a person is available. So the income tax department can go back to those PAN numbers or those assessees and ask in case they have paid tax on the amount that has been written off by somebody else.
So the one thing is that anything which is a bad debt for a person, he is not under obligation to deduct tax under section 194R. For any operational creditor, the dues have gone into the company has the companies where they are supposed to receive their debtors. Those companies have gone into insolvency, and for them it is a bad debt, so they are not supposed to deduct tax at source under section 194R. I think we can take some of the questions at this point of time, Ankit. Although there are many more things that, unless I say that,
so I think
or
we'll just
alternatively,
we will just answer these questions quickly. I think that's how we should do it. Uh, so question number one, that when you make income tax office a party at the time of approval that you file with the NCLT, will it not result to delay? So I think there the idea, I think this question has come from Mr. Ram Kumar. But the idea is that if you give an opportunity to the income tax officer or the income tax office to represent their part or say their part at that stage, then it also gives a surety that yes, this is not supposed to be contended, or the income tax officer will not be able to contend this at a later stage. Whether they appear or
yes,
not, put forward anything or not, is something which is, of course, dependent on how agile they are. But then it will give protection to the resolution applicant, because we have seen several cases where after the resolution has been passed, the income tax office goes to the NCLAT and says that this resolution plan was passed without our concurrence. Kindly set it off, set it. Don't allow this to continue. So that's, I think, better. Then carry forward. Desi Khan Madhuji is saying that. Sir, okay, carry forward is available, but can it be carried forward without taking over liability towards FC? So we have talked about how the liability is settled and how the liability is taxed now. So I think this stands answered. Then Ravi Sharma, I think Ravi Sharma ji is talking about the new tax regime. I think we will be discussing that shortly, Ravi ji. So that should be answered then. Then so then the next question is when SRA gives a proposal for the liquidation value of assets, then should the SRA not give a higher value as compared to the liquidation value, because they're getting some kind of benefit from the carried forward losses. So carried forward losses and
no,
unabsorbed
we will,
depreciation.
we will.
Yeah, yeah. So we will talk about
We
this.
see.
This is
I'm sure when we complete this deliberations today, this question will automatically be answered.
so. Let's I think continue then. I think we will take more questions when we are further into the presentation.
So some importance is also there when we calculate the profit taxable liability after the resolution plan is approved. We also need to understand section 43B, section 40 and section 40A of the Income Tax Act. Section 43B is basically certain deductions to be allowed only on actual payment, like the interest, like tax, duty, cess, provident fund, bonus, superannuation fund, gratuity fund. So these are some of the expenditures that we claim in the profit and loss account. We create a liability in the balance sheet, but we don't pay. So what is impacting? My book profit is reducing, but my taxable profit will actually get added. This 43B says that you'll have to add back in case you have not paid. Like I will definitely say that I have debited my profit and loss account by the total interest liability, provident fund liability, bonus liability, employees the leave encashment liability, everything I have debited to profit and loss account and created a liability. When we file my return under the Income Tax Act, the tax auditors are supposed to highlight these items and they have to disallow under section 43B. Similarly, section 40 and section 40A of the Income Tax also provides various circumstances where you have claimed certain expenditures out of the profit and loss account as you prepared as per the Companies Act. But while preparing the income tax return, these expenditures are not deductible under section 40 and 40A. Some of these instances can be that in case you don't deduct tax at source, appropriately, then these amounts will not be deductible. So whatever has been deducted from your income, whatever has been deducted from your expenditure, this will impact my obligation under Section 41, subsection 1 of the Income Tax Act. So this was very important to understand. Now coming to the how the brought forward losses would get consumed. How the brought forward losses will get consumed after the approval of the resolution plan by NCLT. Because once the resolution plan is approved by NCLT, and the first thing that actually will impact me adversely is the haircuts. Haircuts are taxable under Section 41, subsection 1 of the Income Tax Act, and also under Section 28, subsection 4 of the Income Tax Act. These two sections will bring all these waivers, remissions of liability, cessation of liability to taxation. So whether it is convertible into money or not, that amendment has already been given in the Act with effect from 1/4/2023, just to diffuse the Supreme Court judgment in the case of Commissioner versus Mahindra & Mahindra. So this is the first difficulty when I take over a company under IBC and prepare a first balance sheet after the approval of the resolution plan. Then all the liabilities, what are those liabilities? The reduction or waiver of term loans, full or part waiver of working capital loan, full or part waiver of public deposits that I have taken from public at large, waiver partly or fully of unsecured loans, waiver partly or fully of operational creditors, advances from customers, or any other kind of liability. All these liabilities would be taxable either under Section 41 or under Section 28(4). We will see what is taxable under what section. So first of all this will come to my profit and loss account, and my profit and loss account will balloon. It will show me a profit of huge amount of profit. Then what we normally do to bring down this profit, we also look at the other side of the balance sheet that we have taken over. And in case we have some inventory in the financial statements, profit and loss account closing stock, we also can see whether these stocks are really available physically, or the value of the stock is the same as provided in the last closing stock. So in case the value is less, or in case the stock is not available, that also we should provide, so that against this income of waiver, remission, and cessation, we also have some expenditure or some losses, so that to reduce the profit on account of waivers. Also, in case we have some receivables, some advances as assets, and those also can be brought to the profit and loss account as losses, as expenditures, or as not recoverable, or as bad debts. Any kind of, however, one have to be very, very careful. Any erosion in the value of the fixed assets, that is not subject to allowance, that is not allowed under the Income Tax Act as expenditure. Any impairment on investments or capital asset, that is also not allowed as an expenditure. So what we can do is only current assets, current advances. Those are the only items which can be, those are the only current assets which can be reduced to a normal recoverable amount, and the difference between the books of account and the actual recoverable amount, that can be brought to the profit and loss account. So one side we have brought the income out of waivers, remissions of liability, and the cessation of liability. On the other side, we have brought the losses. Now let us see what happens in all these cases. So then we actually try to calculate the tax liability post approval of a resolution plan. So the first one is the Section 41, subsection 1 of the Income Tax Act, which is the remission and cessation of liability after the resolution plan is approved. So it is very clear. It is very clear that the section says, where an allowance or deduction has been made in the assessment year for any year in respect of loss, expenditure, or trading liability incurred by the assessee and subsequently during any previous year. So this is something that we have claimed a loss. We have claimed a deduction or an allowance for any loss, expenditure, and trading liability. And then the assessee has appraised whether in cash or any amount respective. So later on, either that particular loss or expenditure or trading liability, whatever has actually been claimed from the income tax department, that actually becomes not payable. Maybe that the expenditure has been reduced by the claimant. The liability is not payable. Then this amount is taxable. So this section 41(1) is only and only applicable if a liability has been created. If a liability has been created in books of account by claiming an expenditure or a loss or a trading liability. This is very, very important, that the Mahindra and Mahindra judgment of Honorable Supreme Court says that in this manner, the term loans are not a liability by claiming a loss or expenditure or a trading liability. Therefore, term loans are not taxable under Section 41, subsection 1 of the Income Tax Act. However, there is one important part in this section. For the purpose of this section, there is an explanation 1 to this section. The expression loss or expenditure or some benefit in respect of any such trading liability by way of remission or cessation shall include the remission or cessation of any liability by a unilateral act by the assessee by way of writing of such liability in his accounts. Now it says that if the assessee unilaterally write off any liability, that is also considered as taxable in that year in which it is written off. So this part, I will come back again to say that there is some kind of tax planning that can be done against this clause. I will come to this slightly later. Now, this section 28, subsection 4, because it has also seen an amendment with effect from 1st of April 2024. However, any transaction after 1st of April 2023, this amended section would be applicable. Now, although the earlier also the section was very clear, however, the Mahindra and Mahindra judgment in fact created this kind of confusion. Now it is clear that any waiver, any remission, any cessation is taxable. So this is the judgment of Mahindra and Mahindra, and we have already said that Mahindra and Mahindra in fact very clearly said that the section 28(4) is only applicable to non-cash benefits, and section 41(1) is only applicable to remission and cessation of liability where that particular expenditure or loss or trading liability has been created. So it was held that the term loan or capital liabilities, any liability against the purchase of capital equipment, that would not be considered as taxable under this section 41(1). However, that will be taxable under section 28, subsection 4. So this judgment finally, this judgment has now brought back by the department by making an amendment in section 28, subsection 4. Even if the section 41, subsection 1 continues to remain the same as in case there is a waiver of working capital loan, it will be taxed under section 41(1). However, in case it's a waiver of term loan, it will be taxed under section 28, subsection 4. So this particular benefit, now in fact, after that Mahindra and Mahindra, there are various judgments which has come from various high courts and the tribunals. Everywhere, the concept has been almost fortified that under section 41(1), any liability created out of a term liability, any liability created of purchasing a capital asset, any liability created out of an investment in the long-term investments, all those liabilities would not be taxable when waived under Section 41(1). However, the judgments very clearly says, even post this judgment, in the case of Rolla Trainers, the judgment which says that the working capital waivers are taxable under Section 41(1). After the amendment, this Section 28(4), this is very clear now. This concept, why I have brought all these sections, all these judgments, because so far it was fortified, and therefore the government had to come with an amendment under Section 28 subsection 4, where all kind of waivers would be taxable, all kind of benefits would be taxable. So that's the kind of Ankit, the impact that we have seen from, because there is no point discussing all these judgments. What we are saying is that in these judgments, the concept is very clear. Now, when we try to calculate the tax liability post approval of resolution plan. So this part, Ankit, I'm going to explain very carefully. First of all, after the resolution plan is approved, whatever profit is coming in the books of account, that is my profit. Then we have to add into our profit term loans waived as per resolution plan or reduced as per resolution plan, that is taxable under Section 28 subsection 4. Any kind of liability against purchase of capital assets, that also will be taxed under Section 28 subsection 4. Any kind of liability against which some kind of capital investment has been made, that also will be taxed under Section 28 subsection 4. So in our profit, we will have to add this while we'll prepare our computation of income. Then working capital loans waivers, that will be added under Section 41(1). Operational creditors, add under Section 41(1). Unsecured loans waivers, 41(1). Advances from customers, 41(1). Any other liability which is waived as per the resolution plan, but it was appearing in the books of account, will be waived, and this is my total income. Then I will have to reduce. So what I will reduce? Now I will reduce from this computation all those expenditures which I claimed in my books of account, and it was disallowed under Section 43(b). But those liabilities are still appearing in my balance sheet and is being waived now. So what I'm trying to say is that the liability was created, it was disallowed under Section 43(b), but the liability is still there in my balance sheet. When that liability will be waived, it cannot be again taxed under Section 41(1). So this will be reduced from the computation of income. Then any such expenditure which has been not admissible under Section 40 and 40A, and the liability is still appearing in my balance sheet, and that liability has also been waived, that also will be reduced from the computation of income. Then I will say that any kind of debtor outstanding in my balance sheet which is not recoverable, that we can write off. Any inventory which is not physically available or the value of that inventory is much lesser, that amount can also be reduced. And however, this any other current asset which is not realizable or the realizable value is much lower, that can be brought to the normal value, and the rest of the amount can be written off to reduce this computation of income. However, the capital losses, as I said, that cannot be. Then comes one amendment which is there in all unabsorbed losses, because Section 79 has been amended. Then we reduce all brought forward losses, unabsorbed depreciation, and that is what is my taxable income for the purpose of paying taxes. In most of the cases, wherever the haircut is higher, this amount actually will become taxable in the hands of the company after the approval of resolution plan. And this will consume all my brought forward losses. In some cases, although the brought forward losses are visible in the balance sheet, but those brought forward losses may not be even admissible by the income tax department. those losses, whatever has been claimed by the SSC company, those might have been disallowed by the income tax department. So all that would be a very big struggle for the successful resolution applicant. So therefore, the brought forward losses, unabsorbed depreciation is something that has to be very, very careful due diligence. Without due diligence of unabsorbed losses, without the due diligence of the total tax liability, it is not advisable to venture into taking over companies. Otherwise, this tax liability can be huge on you. Now, this is something which is a normal tax liability. When we come to the liability under section 115JB, minimum alternate tax, what we have seen practically, that whatever we are doing, reducing, in fact, this part, when I said that this part, the row number 1 and 2, that is not permitted under section 115JB, because that's not that adjustment is not allowable. See, because the 115JB is talking about the book profit after waiving the liabilities and after writing of the current assets. Because this adjustment of 43B, section 40 and 40A, that will not show up here. And then I will be allowed to reduce all my brought forward losses and depreciation as per income tax department, not as per books of account. And whatever would be the balance, I would be having a liability to pay MAT. I would be having a liability to pay MAT on this also. So Ankit, we can take some questions on this. Since we have almost concluded our deliberations, I will come to the conclusion after the question answer session.
So basically the question that is coming is the assignment of debt, will it help reduce the impact of waiver of loan in the books of the CD and thereby having less tax impact? I think it's only has a delay mechanism, right? We discussed this earlier.
Assignment of debt is something that is being done, and the assignment of debt, in case we take the assignment in one name, in one of the company, and then later on your balance sheet will continue to carry on the liability, which is a huge liability, and the balance sheet of the corporate debtor after the resolution plan will become almost unacceptable to financial institutions, because the liability of that balance sheet would be huge, and that would be without the haircut, and the debt equity ratio would be spoiled, the debt service coverage ratio would be spoiled. So that's not suitable to everyone. And also the financial creditors, the secured financial creditors, they are not willing to assign. Because see, once they assign, that also means that the personal guarantees attached to that particular loan, corporate guarantees attached to that particular loan also gets assigned. So that actually gives them a kind of challenge, that how can they face this particular allegation that they have also waived the personal guarantees, they have also waived the corporate guarantees along with this assignment. So we tried many times. In one or two cases, we got success. In other cases, we couldn't get success because the banks could understand that after the assignment of the total loan, they would have no bank balance, so that they would not be able to enforce the personal guarantees and also the corporate guarantees. So the assignment is a solution, provided it is acceptable to the financial creditor, which is presently not. They don't accept that part of it. Because they also try to find that how can we assign the loan? How can they assign the loan without assigning the personal guarantee? But their lawyers, their legal department declined that there is no way that you can assign the loan, total loan, and still keep the personal guarantee with you. That was not legally possible. Yes, Ankit.
So Arvind Bansalji from IDBI is asking, SRA acquires some investment under resolution plan. Now, subsequent to implementation of RP, the SRA wants to dispose of the investment at a value below book value as calculated under section 11 UA. So what is the implication on the SRA? So as we discussed, there are two sections here. One is 50CA and the other is 56 to 10. both these sections become applicable. 56(2)(10) in this case would be applicable to the person acquiring the shares from the SRA, and the SRA, or rather the SRA will be subject to section 50CA, where the sale consideration that the SRA is getting will be replaced with the higher sale consideration, which is the fair value of the shares as computed under 11 UA. So therefore, this is the change that will happen, and this is the taxation. So it will end up being a double taxation for the buyer as well as the seller. The way it happens wherever you sell a property less than the circle rate.
I think the question was like in the SRA has some investment in the balance sheet of the corporate debtor, and the SRA wanted to sell those investments at a value which is below the fair market value as per 11U. Maybe that question can be answered slightly differently
So
because
you're
of the
saying, I
after
think
the resolution.
I think the idea was the SRA, SRA's investment is the investment in the company which the CD that has been obtained, right? That's what should it be?
So anyway, we can also answer the other part.
Yes.
After the resolution plan is approved, if the SRA is trying to sell any investment which is in the balance sheet of the corporate debtor at a value which is less than the fair market value, the section 56 subsection 2 and the clause X and subclause C would be applicable, and it would be taxed in the hands of the buyer
No.
as well as in the hands of the seller.
So 56(2)(10) will be applicable on the buyer, and 50CA will be applicable to the seller. So the SRA,
Absolutely.
the company will
Absolutely.
actually have a higher sale consideration for the purpose of computing the tax under 50CA. So 50CA would
Absolutely.
increase the sale price effectively for income tax purposes.
Right.
Then Pradeep ji is asking that is it not a better option to buy only the assets instead of the full company? Now that's Pradeep ji. Yes, in liquidation
When
when
we buy
somebody, yeah. So there
when we
is,
buy assets, I think we also pay stamp duty. So and also pay GST whenever it is
and
applicable.
also, and in some circumstances, like you can't imagine larger resolution plans to function where you're not taking over the entire entity, because a lot of licenses, a lot of active operations, they are in the name of the company. Certain contracts are in name of the company which cannot be shifted. So it would depend. So it would, of course, where a company does not have any going concern business and does not have any active licenses, this might make sense,
Yeah.
subject to the stamp duty and everything, other taxes.
When we try to buy the company as a going concern, it also comes along with the technology, human resources, customers, all that cannot be purchased by way of like when the resolution plan is a resolution plan. The resolution plan cannot be sale of assets.
So
But the
one
sale
of
of assets
the
can only happen in liquidation, not in the resolution process.
questions is that in case somebody is buying the entire CD, and rather the company as a whole under the liquidation regulations, what will happen then? Because effectively that does become a resolution plan where the NCLT does talk about how under liquidation as a going concern where the company is being taken over by somebody else, the entire company's balance sheet then starts being prepared or is then prepared by the resolution applicant. So how will all this work where this happens through liquidation route? So will it be similar to the CARP process or can it be a little different?
So we only have seen that the section 79 is only the impactful, because in section 79 it is said that the resolution plan has been approved by the adjudicating authority. However, in the case of 115JB, it is only said that the CIRP under section 7, 9 or 10 is started. So when it's like whenever a liquidation, in the liquidation process, the company is being sold as a going concern, normally we pray to the adjudicating authority that it should be considered as akin to resolution plan. And we assume that most of these benefits which are available to resolution plan would also be available to sale of the company as a going concern. That's an assumption. However, there is no, the reaction of the income tax department has not been seen in any case so far.
Another question is, what is the impact of the treatment of waiver of existing shareholding under the resolution plan? So, for example, let's say a resolution plan is approved by the NCLT and that resolution plan extinguishes the existing shareholding of all the shareholders. Can those shareholders file an income tax return and say that this was an investment held by me? My cost was, say, 1 crore rupee with respect to their shareholding, and I have received nothing against these shares through this resolution plan. And therefore, can they claim a loss of 1 crore rupees or maybe the
Certainly,
indexed
they can
loss?
claim a capital loss. They
Yeah,
can
they can
claim a
claim a
capital,
capital loss. So that will be an
and the capital
option
loss
which
can also be that can also be carried forward for future adjustment against capital gains.
yeah. So if we are preparing balance sheets for earlier years, also after approval of resolution plan, do we need to consider the impairment loss in earlier years also for balance sheet purpose? That's a question from Anand Manojaji.
Now, as far as this impairment is concerned, that's a call that you have to take according to the accounting standards. However, the impairment of assets, impairment of investments would not impact your tax liability, either normal tax liability or the tax liability under Section 115JB, because both these items are not allowed as an expenditure, either from the taxable profits or from the book profits. In the book profit also, it is supposed to be reduced. So this is a call that has to be taken as per the accounting standard. It doesn't have any impact on the taxation.
Okay. Then we have a question which says that if CD has not filed returns for 4 to 5 years, can the penalty be waived if RP attempts to make audited financials and file returns? I think our experience has been that the waiver does not come in. There is no waiver that ROC gives. There is no waiver that any of the filing processes grants to wherever these filings are being completed for the during the insolvency period also. I
No, I
hope.
think the Ministry of Corporate Affairs has introduced the GNL2 form, where all
Mhm.
the pending filings can be done with one filing fee, one filing fee, not the multiple, not a multiplier of the filing fee.
Hmm.
So they take on record all the earlier balance sheets and all MDT7, all these are taken on record without asking for additional filing fee. However, the income tax department has not come out. I believe the income tax department already has provisions that if a particular assessee was prevented by sufficient cause, then the penalties can be waived. So once the penalty is levied by the assessing officer, it can be appealed against and it can be waived.
Hmm. Okay. So I think there are many more questions, but I think we will be really running through our time limits. So we can just close the conclusion and then maybe close it because we're already 10 minutes up.
So I think we need to conclude after all this. There is only one way that I could see to circumvent some of the such kind of because one I saw the section 41(1), which says that even if unilaterally the liabilities are waived off, it will be considered as a waiver and it will be taxable in the year it is waived unilaterally. So in some cases where the financial statements are pending, profit and loss are pending, then before the commencement of CIRP, when the RP is making, then all these waivers can be entered into the books of account on an asset basis. And those waivers, even if it is taxable in those years, those will be a period which is prior to commencement of CIRP, and such a huge tax liability can be averted. But overall, I may say that the demand in the market or the kind of assumption in the market that the successful resolution applicants are getting a lot of benefits of the brought forward losses and depreciation, that is not lucrative. That can be fake. That can be a misunderstanding. Because according to my understanding, the kind of haircuts that we can see nowadays, I think there's no company or there's hardly any 1 or 2% companies where this kind of benefit has been taken by the successful resolution applicant. Now, writing of liabilities during CIRP also would attract. in case the RP, in case some of the SRA says that you write off the liabilities during CIRP period, that actually will become the taxable and it will become the CIRP cost, and that will be fatal because then it is not possible to take a claim for the tax liability which is incurred during CIRP period. That is fatal. So no RP should write off the liabilities while the balance sheets are being made during CIRP period. Writing of current assets before taking over the corporate debtor by the successful resolution applicant is also not advisable, because see, that is some kind of relief available against the waivers and cessations, that we also can get some losses out of the current assets, then we can set them off together so that the tax liability is reduced. So in case SRA says that you bring my current assets as per the valuation report, that is not advisable. It will be fatal. It will bring tax liabilities. Now, the loan liabilities cannot be loan waivers cannot be transferred to capital reserve. Somebody might guide you that you transfer it to capital reserve. We will manage, but management is not that we are discussing. The management of the income tax department is that we are discussing. We are discussing pure law. The pure law says the income tax department can proceed against you. All the transactions routed directly to the capital reserve can be taxed. Therefore, careful calculations are required before a company is taken over. Even if the company is suitable to you, even if you think that the company is coming to you at a very, very reasonable price, that an unforeseen tax liability can come to you as a shock. Be careful. That's what is the conclusion that we want to say. One, planning that like we can waive some of the liabilities before the CIRP period in case some of the balance sheets are pending. That's the only one thing that we can see. Assignment also, in some cases, it might work. Assignment of debt, it might work. So this is what is the Ankit. Anything that closing you want to say? Because I have seen there is no relief from all this. I can discuss with anyone that this tax liability can be a huge liability in case it is not properly seen before the company is taken over.
Yeah, I think what we can do is we can just I agree with you, and I think this is what is the idea. But then
I think you can also for a minute we can discuss what about this section 115 BAA in case we go to that regime, and in
so
that
in
case
case
the
we
brought
go,
forward losses are not
yeah.
applicable.
So in case we go to the 115 BAA, the brought forward losses and unabsorbed depreciation is available unless and until those losses and depreciation are on account of certain deductions that are disallowed under 115 BAA or BAB. So that new regime certainly would help a company, get over any taxation that is coming on under MAT regulations, because as soon as a company opts for 115 BAA, MAT also gets MAT becomes not applicable, because there that provision becomes useful. So that provision, I guess, if somebody opts for 115 BAA, then of course you pay 25% taxation, including all the surcharges and the surcharges. And secondly, MAT becomes not applicable. So both these things then become better. So I was wondering, in case there is any difference of opinion from anyone, do you think we have the time to take any raised hands?
I think it is already 12:15.
We are already running late.
We would like to discuss offline.
Yes. So any other opinion that anyone has, please, we will be more than happy to discuss that offline.
Any email will come to us and we will have a call with that person, so that we just want to clarify if there is any other view which is coming from the market. We would like to assess that before this spreads around, that the taking over a company can be as fatal under the IBC because of the tax liability. The moment before it becomes like it spreads around, I believe in case anyone has a different opinion, if they can send me a WhatsApp or they can send me an email, I can definitely discuss with them, so that we should try to find out a collective solution to this kind of tax liability, which can come to successful resolution applicant. Thank you. Thank you
Thank
very much.
you. Thank you, everyone.
Thank you.